welcome to the Deep Dive. We're your shortcut today to understanding, well, the real engine room of business finance. We're diving into the accounting process and its core rules, basically the logic behind how money gets tracked. Ever wonder how, all those daily bits of buying and selling, big and small, end up as those need financial reports? It seems complex, but there's a system. And today, our mission is to sort of decode the essentials for you.
It really is the language of business. And this deep dive, it's not just definitions. It's about getting the framework, especially that powerful double entry system. That's what makes the data reliable, consistent. Understanding this, well, it gives you a crucial lens, helps you be genuinely well informed about how companies actually work.
Okay, let's unpack that.
Right.
Where does a transaction even start its journey in this system?
It all kicks off with recording, capturing those daily activities.
Like sales, purchases, paying bills.
Exactly. And they get logged chronologically right as they happen. This happens in a primary book, usually called the journal. Think of it as the business's raw diary.
The diary. Okay, so everything goes in there first. What's next?
Next is classification. This is where you start organizing. Imagine gathering up all the similar items from the journal. So all your CAF transactions, for instance, inflows, outflows, they get grouped together. They're posted into a specific cash account within another book, the ledger.
The ledger. So journal's the diary. Ledger is more like organized files.
That's a good way to put it. It lets you see the total picture for specific things, not just isolated events.
Okay, diary, files.
Yeah.
Then what? How do we get to those reports?
That's the summarizing stage. You take all that classified information from the ledger and you condense it. This leads directly to preparing the final accounts, usually done at the end of an accounting period, like a year.
And these are the big ones people hear about.
Right. The trading and profit and loss account that tells you if you made money or lost it, and the balance sheet, that's the snapshot, what the business owns, what it owes at a specific point in time.
So recording, classifying, summarizing. Journal, ledger, final accounts.
And the key thing, it's a loop. It doesn't just happen once. It's continuous, repeats over and over.
So that's why it's called the accounting cycle.
Precisely. That cyclical nature provides consistency. You can track things over time, make comparisons. It's invaluable.
Makes sense. So we keep saying accounts, cash account, sales account. What is an account, technically speaking?
Good question. Think of it like a dedicated page or record. It summarizes all the activity for one specific thing, a person, an asset, an expense, whatever it is.
And they have that T-shape you sometimes see.
Exactly. It visually represents the two sides. The left-hand side is the debit side, or doctor buy, and the right-hand side is the credit side, CR. That structure is fundamental.
Okay. And these accounts, they fall into different types?
Yes. Three main classifications, really. First, personal accounts. These track dealings with people or other entities, so like Krishna's account, if you owe Krishna money, or your bank account. Even things like salaries outstanding are personal. They represent people you owe. Or capital account, representing the owner.
Okay, people and entities. What else?
Then you have real accounts. These are about property, assets, tangible things, mostly. Stuff the business owns that has value.
Yeah.
Machinery account, furniture account, even cash account is considered a real account. It's a physical asset.
Got it. Assets. And the third type?
Nominal accounts, that are temporary. They track the flow of money related to operations within a period. So all your expenses, losses, incomes, gains, think wages account, rent account, commission received account. They show how you performed.
Personal, real, nominal. Okay. Now, here's where it gets really interesting, I think. This principle of double entry.
Yes. This is the absolute bedrock, the genius of it, really.
It sounds simple but profound. Every single transaction has two sides.
Two aspects, yes. A receiving aspect and a giving aspect. Always. You can't have one without the other.
And the core idea is?
For every debit entry you make, there must be a corresponding credit entry of the exact same amount. It has to balance. That's the self-checking mechanism built right in. It makes errors much harder to miss.
So, like that example you mentioned earlier. Buying machinery with cash.
Perfect example. The business receives machinery, so the machinery account gets the debit. It's the receiving aspect. At the same time, the business gives cash, so the cash account gets the credit, the giving aspect. Equal and opposite.
Okay, that makes sense. But how do we know which account gets the debit and which gets the credit for all those different types? Personal, real, nominal.
That's where the specific rules come in. They're just practical applications of that dual aspect idea.
Okay, lay them on us.
For personal accounts, the rule is debit the receiver, credit the giver. So if you pay cash to Ramesh & Co is receiving. You debit their account.
Debit the receiver. Okay.
For real accounts, the assets, it's debit what comes in, credit what goes out. If you receive cash from Ajay, cash is coming in. So you debit the cash account.
Debit what comes in. Makes sense for assets. And nominal.
For nominal accounts expenses, incomes, the rule is, debit expenses and losses, credit incomes and gains. So if you pay rent, that's an expense. You debit the rent account. If you receive commission, that's income. You credit commission received account.
Debit expenses, credit incomes.
Right. See? These rules aren't arbitrary. They just consistently apply that fundamental idea, who or what gave the benefit and who or what provided it.
Wow. Okay. So pulling this all together for you listening, understanding this accounting cycle, the different account types, and especially these double entry rules, it gives you a really powerful lens, doesn't it?
Yeah.
You can see how financial information isn't just pulled out of thin air. It's meticulously constructed.
Exactly. It's not just numbers. It's a logical story, a balanced story. And it raises a bigger question, maybe. If every single financial action truly has an equal and opposite reaction built into the system, what does that fundamental balance suggest about the potential for transparency, for trustworthiness, and financial reporting overall? Something to think about.
A very interesting thought to leave things on. Thanks so much for joining us for this deep dive.